try. And we will be recording this tonight so we can post it on YouTube.
Perfect. Philip, just to double check again, you can hear me and you see my presentation in presentation mode, sir?
Yes, sir. Loud and clear and looks good. Nope. Now
Wonderful.
we're not in presentation mode anymore. Now
I think we should be okay. Yeah, I had to give the blessing that I was okay being recorded. So I think we're ready to rock and roll. So yeah, thank you all for inviting me to come speak with you remotely here. Tonight we are going to talk about farm record keeping and taxes from the farmer's market perspective. And you know, in general, it doesn't really matter what business we're talking about. You know, the basics are the same, but I am going to try to approach this from the farmer market standpoint. Record keeping is the cornerstone of farm management. I think that is the biggest thing to, you know, kind of get your head wrapped around. The problem with record keeping is that it's not fun. And I understand that. I deal with a lot of record keeping myself, and I very well know the importance of it, but I still find myself struggling to get it done sometimes. I get behind on my farm accounting and my checkbook, and it just, you know, I have to keep reminding myself, you know, that it is super important. And so I say that just to point out, if you've struggled with record keeping or don't enjoy it, you're probably far more normal than you realize, because it's not a fun thing, but it is a super important thing. And so I'm going to approach this also from the perspective of, we've got really not two sets of books that we need to keep per se, but we keep records for different reasons. And there is some overlap, but the two biggest reasons that we keep taxes is for management purposes, and then of course to make sure that we are compliant with income tax reporting. But there is overlap between the two, but everything that you keep track of for management purposes is not going to be, you know, pertinent to your tax reporting, and vice versa. So that begs the question, even though I've kind of gave you a little bit of a spoiler there, why do we keep records? In my position with what I do as a farm management specialist, I'm very biased. And so I feel very much that we should have the first primary main goal of keeping records for management purposes. Good records that are kept this way will help us in our decision making. And in the current lending environment, if we're having to take out loans to operate our business, it's, you know, universally required to have good data to be able to provide to lenders in order to get a loan. And so I argue that once we keep records at the level of detail that we need to make management decisions, we have overlapped enough and covered all the areas for taxes. So it's just a different way to think about it. You know, if we're keeping records good enough to make management decisions, then our taxes are going to be super easy to do, whether we're doing the taxes ourselves or we're hiring somebody else to help us out in that aspect. And that last bullet point there, a well-kept set of records is the most valuable tool in your business. I truly believe that. Once again, there is bias for me. But at the same time, I have had many farmers tell me that. Typically, this comes from farmers that keep good records and have used them in their businesses, and you know, are maybe a little bit longer in the tooth, so to speak, in terms of the length of their business, but they've realized that it is truly a tool that you use. And the better we do with that, the better tool that we have. So just the term record keeping, though, is quite broad. And so I kind of want to talk through what should we keep records on. And then in a couple slides, we will discuss, you know, the concept of benefit versus cost with record keeping. So in general, at the most basic level, we need to be keeping up with all of our financial transactions, all of our cash sales. So anything that we sell either off the farm or at the farmer's market, we need to keep track of that. which understandably, well, some of that is actual cash transactions. So coming up with some kind of ledger book or whatever works for you to keep track of that is really important. Accounts receivable and accounts payable. So if you deliver goods to someone that takes a while to pay, or maybe you're delivering to a business that only pays every 15th of the month, keeping track of those accounts receivable is important. And then of course, money that you owe other people is important. Outside of that, those are probably the three biggest areas that you really, as far as financial transactions are concerned, that you really want to keep up with. But it's also really important, if you do have loans, to keep up with those loans as well. Somewhere it's good to have like a list of what the loan's for, the origination amount, the origination date, that when the loan is to be, when it matures, interest rates, and then have a payment schedule of principal and interest. If you've only got a couple loans, that may not be that hard for you to keep up just within your head. But sometimes people have many loans, and it can become cumbersome to try to keep up with all of that. It isn't just about financial records, though. We also need to keep records on our actual production as well. And so the reason to do this, and there may be reasons outside of what I say. You may be required, if you're part of a co-op, or if you're selling wholesale or something like that, there may be more stringent record keeping requirements here. But we do this so that we can keep track of performance, basically. So we can track how well did a particular plant do, or a particular enterprise do in our farm. So if we keep up with how many acres or areas or spaces, or however you define that, planted to, tomatoes versus bell peppers versus lettuce, and then you keep track of how much you've harvested from that, then we can arrive at some interesting things to talk about as far as productivity. It helps you track that over time, and then we can arrive at, does this enterprise still make sense to include in our operation here? And sometimes I understand as well that sometimes we have to produce things that maybe are not that profitable, but it attracts people to us. So it's okay, that's totally okay to have things like that. But also understanding what that's costing is important too. And then if you have to rely on herbicides and insecticides, I'm not well versed on a lot of vegetable production, so I'm not sure what the standards are. But if you are in that, keeping track of that is important. And like I said, if you're part of a program that requires you to do certifications, you're probably required to keep track of that anyway. So what we do want to try to avoid is something that I use the term analysis paralysis for. This term, of course, I didn't make it up. It's been around a very long time, and I've tried to represent that, what that makes me think of, with that little picture there on the left-hand side of the screen, where we're at the corner and there's a bunch of different directions to go in. One thing that I will say about record keeping is the records need to work for you. So you're doing this to make your life easier, to give you more information, and to help you make better decisions. Does it always mean that the more information we collect, the better? I argue no. Sometimes there is a cost to collecting more information, and the benefit that we get out of that isn't worth what it took to collect that information. For example, it may be worth keeping up, with quality of, or grades of certain vegetables, for example, to help track profitability and just track performance. But with something like pumpkins, if you've got an acre of pumpkins or something, it may not be worth, trying to track, okay, how many pumpkins were this grade or that grade, or whatever the case may be. And so oftentimes I feel like when people are approached, when people have questions about record keeping and they solicit advice on that, sometimes the advice is, basically you need to keep records on everything. And the more records that you can keep, the better off that you are. Just realize that at the end of the day, this is for you and what you're trying to achieve. And you need to make this record keeping system and what you keep track of something that works for you. And it could be that your neighbor and you are engaged in very similar enterprises. You're growing very similar crops, and they keep records a lot more detailed than what you do. But that's okay, as long as you're getting the information that you need to make those management decisions, satisfy the bank if that's an issue for you, and get your taxes filed. That's all that you need. So try to avoid the analysis paralysis of thinking that you've just got to cast a wide net and capture everything and then figure out what to do with it. If you're new to this and new to record keeping, I also encourage you not to bite off more than you can chew at one time. So set reasonable goals for yourself as far as, for the 2023 season, I am going to work on increasing my record keeping performance in a certain area, and don't think that we have to do this all at once. We can evolve into this as time allows. A question that I get a lot from all over the spectrum of agriculture is, how do I actually go about this record keeping process? And once again, this is another area that I get frustrated in, because there's a lot of very strong opinions about the best way to go about this. I have worked with enough farms at this point in my career and realized that everybody has different technical capabilities. Everybody has different ways of learning, and everybody has different ways of processing information. And so what I said a few slides ago about, we're doing this record keeping for you as the owner of the business or the manager of the business. If you choose a record keeping system that works for you, that you understand and that you're comfortable with, you're going to get a lot more out of that than, quote unquote, being forced into doing it a certain way. In the digital age, records on paper are frowned upon, but there's absolutely nothing wrong with still keeping a paper record book. If that's what works for you, by all means do it. At least you're doing it and you're getting the information. We always recommend the UK College of Ag, what we call the Brown record book. Those are still available. Philip can track those down if he doesn't have any. At least I shouldn't be saying this. I think they're still available. They were available as of last year. And sometimes lenders give out a lending or a record book that is very similar to that Brown record book. That's on paper. That's totally okay as well. If you want to go to a computer-based accounting software program, I would say that QuickBooks is probably the most popular off-the-shelf, like we buy things like that anymore. Off the shelf meaning downloadable software program that is used a lot in agriculture. The learning curve is not super big. I think anybody can master it. There's of course a learning curve with trial and error, and help from friends. Everybody can get through it. You can do QuickBooks online. And Quicken is another one that people sometimes use. And then there are some, industry specific accounting software or accounting programs. Veggie Campus is one that is kind of, it's been a few years since I've looked at it, but it captures production components and financial components. In the age that we live, it seems like there's an endless number of apps that are available or being developed. And so there's many opportunities and out there to apps that I haven't even heard of or even seen of that exist. I know they exist, that you can do your accounting with and even some of your production stuff with. And then a spreadsheet, if you're technically savvy and you like doing spreadsheets and kind of creating your own thing, then a Excel spreadsheet or Google Doc spreadsheet or something like that is absolutely fine as well. Your lender may or your tax accountant, if you're not doing your own taxes, may have an opinion about what they want you to use. But I still just encourage you to choose whatever methodology that works for you, because if it works for you, you will actually sit down and take the time to do it, and then you'll have the information that you need. Okay. So not to get too far out in the weeds here, but this is something that comes up from time to time as well, is your actual accounting period. So what is the difference between a calendar year versus a fiscal year? And just to be clear, a calendar year is, and I see a typo here. I'm doing 2 calendar years. That should say calendar year is 01/01/2022 through 12/31/2022. So everybody's familiar with the calendar year. A fiscal year is an accounting period that is any other time period other than January 1 of a given year to December 31 of a given year. With that being said, most small businesses and most farmers operate on a calendar year, not a fiscal year. There really is no tax advantage to shifting to a fiscal year. But I'd just like to cover that too, because sometimes that comes up as a question. Well, should I change my tax period or my record keeping period? For most people, sticking with the calendar year is more simple and just as effective. And that's what I encourage most people to do. So that's kind of the conclusion of the record keeping side. At the end of this, of course, you'll have my contact information. And if you have any questions or want to delve into any of that in more detail, you certainly can reach out to me. Record keeping is, like I said, it's not exciting, but it is super important. So I'd be more than happy to talk to you one-on-one and talk through what it is that you are doing currently and what you want to do in the future. So now we're going to transition into talking about farm taxes. And this is basically I won't say a hodgepodge because there's a little bit of direction here, but these are common tax issues that I've dealt with in my career that I seemingly deal with a lot, that a lot of questions are asked on. So we're going to talk through these and same thing as well. If I'm not covering what it is that you hoped to get out of this tonight, by all means, when you get my contact information, you're more than welcome to follow up with me. So I think we first should just talk about what is a Schedule F. So other than a tax form that you are required to file as a farmer, the IRS says that you must fill this out if you're going to report income and expenses associated with a farming or fishing business. It's essentially just a cash income statement. And so what does it tell us? It tells us the difference between income and expense. I do have to give caution here that if your business model has inventory that is left over from one year to the other, it's not always the best indication of true income for a given year. And I'm making some assumptions here, but a lot of farmers market producers don't have that inventory carrying over like a grain farmer may have grains in a bin. I'm sure that, if you're selling honey or something like that, that you'll have some honey left over that was produced in one year. But that's pretty, in a lot of cases, that's a small adjustment. But I would be remiss if I didn't point that out. But I think for a lot of farmers market producers, you can look at a Schedule F and treat that kind of as an income statement. So I have popped up here what a Schedule F looks like. So even if you don't do your own taxes, I still encourage you to take time to, kind of flip through the tax return once it's complete and just kind of familiarize yourself with, some of the forms that are in there. So the Schedule F, we're looking at the top part here. It asks you to identify, of course, your name, your principal crop activity. There's a code associated with these that asks you to check your accounting method. So once again, most folks, that's going to be cash. There's three questions here, E, F, and G, that I think are important to point out. One, did you materially participate in the operation of the business in 2022? For most people, that's going to be a check yes. There are some situations where that may not be true. The concept of material participation is one of those concepts that is discussed a lot in the Internal Revenue Code. And basically, the issue here is that if you're not a materially participating individual, you cannot deduct your loss against other earned income. But if you're actively participating in the business, as you know, if you're growing the crops and selling the crops, you're going to meet that material participation issue. So E is really not as important as F and G. I want to bring your attention to F and G, and we're going to talk about what a 1099 is and who gets a 1099 in more detail here in a little bit. But question F asks, did you make any payments in 2022 that would require you to file a Form 1099? Yes or no? And if you check yes, then you better check yes on Part G that you have or will send those Form 1099s out. And once again, just keep that in mind. I will go through that in more detail here in a little bit. Part 1, so this is the top half of the Schedule F, of course. It's just lines 1A through line 8 are just different line items for you to report your income on. So if you're producing stuff for a farmer's market, most all of your income, if not all of your income, will go on line 2. If you're buying items from other people and selling them, you know, at your stand or off the farm, then you may have items listed in Part 1A and 1B. The rest of that, lines 3, 4, 5, deal with, you know, cooperative distribution. So if you're part of a co-op, a member of a co-op, and you get a patronage check, you report that there. If you get any government payments, that goes on line 4. Line 5 is a nuanced part of the tax law. If you get CCC loans, that primarily only is going to apply to individuals that are producing grain. If you got any crop insurance, that gets reported by itself. Other income, custom hire, all that gets added up. That gives you your gross income for the year. And then the second part, Part 2, is a listing of expenses. And so these are kind of the most common categories of expenses that, you know, you're going to experience running a farm operation. And, you know, you've got line 10 through line 31 of these pre-filled categories for you. And then you've got several lines, line 32A through F, and you can actually add more if you have expenses that do not fit neatly into those other categories. Then you get to itemize those out. Line 33 is your total expense. Line 34 is your net profit. So literally all we're doing here is just plugging in income on the top half, expense on the bottom half. We're taking the difference between those two numbers, and that's what your net profit is, or loss if it's negative. Don't worry too much about 35 and 36. Those are kind of special situations. So what is a Schedule C? Because I think it's important to walk through this too, because sometimes we have businesses or business ventures that may be part of the farm that actually fall on a Schedule C, even though we oftentimes will just run it through on an F anyway. A Schedule C is just like a Schedule F, except for it's for everybody else. So if you have farm income and expense or fishing income and expense, Schedule F. All other income and expense, if you've got other businesses, it's going to go on a Schedule C. And we're not going to spend as much time walking through this, but I just want to show you that it's essentially the same thing. It looks a little bit different, but the method behind it is exactly the same. Part 1, you're going to list your income. Part 2, you're going to list your expenses. And then by the time you get down to line 31, you're going to take the difference between the two and arrive at what that net profit or loss is. So I strongly encourage folks to check out publication 225, which is known as the Farmer's Tax Guide, that is offered by the Internal Revenue Service. I never thought in my life that I would be in a position where I would actually recommend somebody willingly seek out an IRS publication. But I can tell you that this IRS publication is very well written. It's easy to understand. Most IRS publications, you need to think like a lawyer and a politician simultaneously while standing on your head to try to make any sense out of what they're saying. But this publication is actually written so that you can pick it up, read it, and it makes sense. And it covers the entire gamut of basically what goes on a Schedule F, how you go about it, and it answers a lot of questions about, you know, things that may be in gray areas. These used to get printed off and shipped out, and every extension office in the state had a stack of them. As we've moved to you know, digital stuff, they're available online. You can still get hard copies of these, but you have to seek them out. And with the personnel issues that the IRS has had, and with COVID, it's been hard to get your hand on a physical copy of this, even though they're still available. So I just encourage people to do an internet search for Pub 225, and you'll get a searchable PDF version of it. It is quite lengthy. So if you're going to print it off at home, you're going to print off a bunch of pages. But it's a really good resource to have on hand, even if you're not doing your own taxes. If you've got questions about, you know, for example, farm business expenses and how to count something, or what counts and what doesn't count, it's a really good resource to turn to. So in that vein of thinking, what are deductible expenses? Well, publication 225, this quote comes directly from there, and it says, the ordinary and necessary cost of operating a farm business for profit are deductible business expenses. Ordinary means what most farmers do, and necessary means what is useful and helpful in farming. So there is a vague yet specific definition for you of what ordinary and necessary costs are. And you should feel perfectly educated now, right? Well, that leaves a lot for me to ask, because what are most farmers and what is normal for them may not be normal for me. What I can tell you that, you know, the common ordinary and necessary expenses, and this list that you see on the screen is not exhaustive. You know, these are kind of the things that you think about: fuel costs, seed costs, chemicals, fertilizer, labor, utilities, supplies, rental expenses. You'll see that I've got depreciation bolded there. We'll talk about that separately. Interest costs, veterinary costs, repairs. Basically, if you look back at that Schedule F and you look at lines 10 through 31, that's a really good basic list of expenses that are considered ordinary and necessary for a farm business. But that alone itself is not exclusive either. It is, you may have something weird on your farm that you need something weird for to produce whatever you're producing, and that is still an ordinary expense for your operation. So, you know, if you're using it in the production of profit, then you can count it off as an expense, is another way to think about it. Let's talk about depreciation. Depreciation is an ordinary and necessary expense as well, but the way in which we go about calculating what that is a little bit different. So when we think of depreciation, we have to think about capital expense, or capital expenses, I should say. So the most common things that we're thinking about here, you know, machinery, cars, trucks, equipment, you know, anything you use, basically anything that you use in the production of profit or the production of income in your operation that you expect to last more than a year probably fits the definition of a depreciable asset. So back to the list, things like fencing, if you have livestock, the breeding livestock, if you purchase them, buildings, roads, wells, ponds. This does get a little bit nuanced once you get into dealing with doing things to the land. For example, if I come in with a bulldozer and push down some trees to bring more land into production, that's not an expense that I can take. But if I hire a bulldozer to build me an irrigation pond, then I can set that up on depreciation. So I'm not saying that what I'm telling you here is, exclusive. Just these are kind of the bigger things that we typically think about. So of course, when we're dealing with these kind of items, things that we're purchasing, these bigger ticket items, typically that we expect to last more than a year, then we're going to set this up on a depreciation schedule, and we're going to take a portion of the total cost of that asset over its expected life. The Internal Revenue Service gives us guidance on that. So they tell us, which methodology we use to calculate that depreciation and for how many years we can recover the cost of that. You're not going to do this by hand, most likely. You're probably going to rely on if you're doing your own taxes, you're probably going to use some kind of software to help you calculate this. Or you may do it in Excel or something like that. But the big thing here is that, if I buy a rototiller, for example, I can't write that all off in 1 year. I'm going to depreciate that over, a number of years. Now I'm going to contradict myself here in a little bit, because there are some tax provisions that do allow you to write it all off in 1 year. But assuming we're not invoking one of those, then we're going to depreciate that over time. Another question that I get a lot is mileage deduction versus cost deduction when it comes to vehicles. And so I have put together a slide here just to kind of talk through what are the details of each. And once again, you're probably tired of hearing me give disclaimers, but this isn't all inclusive. If you're going to choose one or the other, make sure that you read on it or get with me and talk through some of it, because there's some nuanced details. But in general, you're either going to choose to depreciate the cost of the vehicle that you've purchased. So you're going to spread the cost out over a number of years, and then you get to take 100% of the fuel, repairs, maintenance cost that you incur while owning that vehicle. Or you're going to take a mileage deduction. So if you take a mileage deduction, you don't get any depreciation deduction. You don't get to count off the cost of oil changes or new tires or a brake job or the fuel. You get reimbursed, or you get to count off as an expense, not reimbursed, count off as an expense an amount per mile driven for the business. So with the mileage deduction, you have to keep really detailed records. There's all kinds of mileage logs out there, the old paper style that you literally keep it in the console or the glove box or in the visor. And every time you hop in the vehicle and you're doing something farm related, whether that's driving to the field to check on crops, move an irrigation pump, or going to town to get supplies, you write down, the date, the starting mileage, the ending mileage, and the purpose for the trip. You are limited on mileage deduction at 5 vehicles in use at the same time. So if your farming operation is sufficiently large enough and you're providing vehicles for your employees to drive in the conductance of business, and you exceed 5 vehicles in use at the same time, you're no longer allowed to use the mileage deduction. You have to go to the cost deduction side. And for 2023, this is 65.5 cents per mile. This is an area that they audit from time to time. But as long as you've got your detailed records, you'll be good to go. The problem that people run into is they forget to do it, because you need to run and go check this field or turn the irrigation pump off over here, and you hop in the vehicle, you drive here, and then you realize, oh, that fitting's broke, I got to run to town, and you grab a new fitting from the hardware store, and then you come back and you forgot to record your mileage. That is just something that you have to work really, really hard to do. You can go back, not from the IRS's perspective. I'm just telling you anecdotally, you can go back and recreate some of that, but you've got to be able to justify, if they come asking questions, how you calculated it and what the trips were for, so on and so forth. On the cost deduction side, swinging back to that, let's say that you've got one vehicle and you use that vehicle part-time for the farm and part-time just for personal stuff. You can choose a percentage. You know, if it's reasonable that you're only using that vehicle 50% of the time for your farm business, then you can take half the value of the vehicle, set it up on depreciation. You can take half the fuel cost, half the repair cost, so on and so forth. If it's 75% or less, this kind of a safe harbor. If you go to a full 100%, technically there's not a safe harbor, and you've got to be able to allocate or justify that this vehicle is only used for farm purposes. What most people do, or I should not say most, what I've seen happen a lot is people will buy a vehicle and say it's 100% for farm, and they're only using it, 50% or 65% for the farm, and the other time it's being used for personal reasons. Those are just risks that we take. I'm not telling you, I'm just telling you what the rules say. I'm not judging you if you're one of those people and are trying to slip by with 100% on the farm when it's really not. Just be aware that questions could be asked. From an economic standpoint, sometimes you can do the math and try to figure out how much you drive per year. And if you've got an older vehicle that you didn't pay a whole lot for, you may actually make money claiming mileage deduction as opposed to setting that thing up on depreciation. So just keep in mind that 5 vehicle at the same time limit. And just a quick clarification on that, you can have 10 vehicles or 20 vehicles and still use mileage deduction as long as no more than 5 are in use at any given period of time. How do you prove that? I guess the mileage records, you wouldn't want to, if you got audited, you wouldn't want to show mileage records justifying your total mileage deduction. And there were 6 vehicles that had mileage on the same day. You violated that 5 vehicle at the same time limit. So that's some thoughts on that. There's also some time limits whenever you make the decision to either go the cost deduction or mileage deduction. And I'd be happy to talk through that some too if you have questions on that. Just a quick reminder that, here in the United States, we do have a progressive tax system. So sometimes people get a little bit confused, understandably so, the difference between what their marginal tax rate and what their effective tax rate is. So this is just from Forbes, just pulled it off the website today. It shows what the taxable or the tax brackets are for single filer taxpayers, and then married filing joint taxpayers on the right-hand side. And so just as a reminder, if you're in the let's say you're in the 24% tax bracket and you're a single filer, you're not paying 24% tax on the federal side for every dollar that you've made. You're paying 10% on the taxes on the amount of money that you made up to $10,275, and then you're paying 12% on the amount over to $10,275 up to $41,775, so on and so forth. So just as a quick little example, assume that a single taxpayer had $25,000 in farm profits, and whenever you combine this with their other income and deductions that they had, their taxable income came to $45,600. This would put them in the 22% marginal tax bracket. But if you go and calculate how much tax is actually owed on that $45,600 taxable income, they would pay $5,649 in in taxes. So for that $45,600 taxable income, 22% marginal bracket, they're actually going to write a check for $5,649, at least that share of their federal taxes. And if you divide that those two numbers out, their effective rate is 12.39%. With that being said, the effective rate does not include FICA, self-employment tax, state or local taxes. So just be careful with that terminology. And, if you're thinking through this, remember that we've got federal taxes, state taxes. If you're self-employed, you got self-employment taxes, and you might very well have local income taxes that are due as well. So let's talk about 1099s. What is a 1099 and who gets one? 1099s are what you as the payer are required to give to the person that you paid, assuming that you have paid that person $600 or more in a calendar year, and assuming that that person is a non-employee. Now, this is only on the business side. Okay, so if you're hiring somebody who is not considered an employee to do work on your farm, you pay them over $600 in a calendar year, then you're required to send them a 1099, assuming that person is taxed as an individual, a limited liability corporate company, or a partnership. You do not have to send 1099s to sub S corporations or sub C corporations, with a couple exceptions, and those exceptions being lawyers and veterinarians. Okay, lawyers and veterinarians are supposed to receive a 1099 if you paid them $600 or more in a calendar year, regardless of what their taxing structure is. That one throws people off, understandably so. I would say that with 1099 compliance, lawyers and veterinarians are probably where we are least compliant, but that is what the actual rule says, that they are supposed to get a 1099 regardless of what their taxing structure is. This is not the same if you hire a lawyer for something personal. Let's say you hire a lawyer to do a will for you, and you pay them $700. You do not have to send that lawyer a 1099 because that was something you had done personally. But let's say that you've got a boundary dispute and you have to get a lawyer to, or one of my favorites is a fencing dispute. Neighbor doesn't want to replace their part of the fence. You have to hire a lawyer to send letters, and it turns out that you paid them more than $600 in a calendar year. You're technically supposed to send that lawyer a 1099. So let's back up here a little bit. On the right-hand side of that first bubble, I tell you that you only have to send 1099s to these individuals that are individuals, LLCs, or partnerships. If you hire someone to come do work for you, how do you know what their taxing structure is? How do you know if they're an individual and tax as an individual, LLC, or a partnership? Also keeping in mind that an LLC can be taxed as an individual or a partnership or a sub S or a sub C corporation. Well, actually just a sub S corporation. So I hire whomever LLC fencing company to come put up a fence for me. My total cost of doing that for their labor is $10,000. I need to send them a 1099. I have no idea what their taxing structure is. The only way that I do know is by asking them to fill out what is called a Form W-9. A Form W-9 requires that person to identify their legal name, their legal business name, their tax identification number, and then they have to disclose to you what their taxing structure is so that you have the information that you need to send them a 1099. I strongly encourage you to do this prior to you actually writing a check to them, because typically once they get paid, not always, I'm painting with a very broad brush, which is not right, but I'm speaking personally here too. I had a guy do some dozer work for me, and then asked him to fill out a W-9 after I paid him, and I never heard from him again. So probably a good idea to get them to fill out that Form W-9 before you give them a check for their labor. Why do I care about this? Wait, I'm getting ahead of myself. What are we giving these 1099s for? These are just some of the more common things like rents, royalties, interest payments, non-employment compensation or commission payments. So rents for a lot of people is a big deal, and then non-employment compensation. So anybody that has done work for you that you've paid over $600 or more in a calendar year that is not an employee. And then, as we've already talked about, fee payments to attorneys or other professional service providers and veterinarians. Those are the big categories for who gets 1099s. What I began to say is, why do I care about this? Am I a secret IRS agent and I just want to create more revenue for the government? I'm not. Not that there would be. I pick on the IRS a lot. I know that they have a very important role in our society, but my goodness, are they a fun organization to poke fun at? But I'm not working for the IRS currently or in the past. The reason I care about this issue is that the amount of money that you as the business owner could be out if you get caught not sending 1099s is increased significantly over the years. So for 2023, if you're late filing your 1099s, it's $50 per return. If you file those 1099s 31 days late, but you get them done before August 1st, it's $110. And then if you fail to file them after August 1st or don't file them at all and you get caught, it's $290 per 1099. And then if they can prove that you intentionally did not send those out, then the fine is doubled to $280. And so remember, this is on a per 1099 basis. So if you had somebody, come do some work for you, harvest work, fix the fence as another person, and you rent your neighbor's farm, for example, and then you hired to put some tin back on a roof, there's possibly 4 1099s that you should have sent out that you didn't. That adds up quick if you get audited. And for small businesses, you can be fined up to $556,000 just on this one issue. And then in the case where they can prove intentional disregard, that $580 a form, or they can take 10% of what your reported income was with no maximum cap on that. That's why I'd like to educate on the 1099 issue, just because the penalties are so high anymore. If you're sitting here and you're are prone to anxiety like I am, and you hear something like this and you're like, well, the deadline's already passed for 2022 and I should have sent those out, don't worry about it. Okay. The only way that you're going to get in trouble is if you get audited. And if you truly didn't know, you're going to be able to argue that it was not intentional, that it was, just ignorance. You may get out of a penalty. But don't worry about what has happened. Just try to correct it going forward. This is an area that they seem to be really interested in as far as, targeting on audits, checking to see if you're sending out those 1099s. And if you remember back to part 1 of the Schedule F, that was, F and G questions. Did you pay anybody that would require you to send a 1099, and did you in fact do that? And so they're asking you to self-disclose. Thinking back to that, if you marked yes on part F that said I did send people 1099s, you better mark yes on part G, because if you don't, that's going to be an automatic audit. So think about that as well. So the rest of this presentation, we're going to talk through just a few things about, trying to minimize, or that is some people's objective, not everybody's objective, but how do we balance income tax liability while also keeping the bank happy, if that is a situation that we're in, and not getting in trouble with the IRS on having too many years of losses. So we're going to talk about a few things here. Typically, the bank wants to see a positive Schedule F. My only cautionary tale here is that the bank does not just take what that net profit is off of the Schedule F at face value. It is possible for you to have a negative Schedule F, so you're showing a loss in the Schedule F, but still be considered a good risk for the bank, because the bank typically adds back in whatever interest you paid for the year and your depreciation expenses. Like I've already said, a lot of people want to minimize the taxes that they pay, but the IRS says that you need three positive years out of the previous 5 consecutive. And so I'll walk you through that. This next topic is, there's a whole lot of slides associated with it, and I'm going to go through it kind of quick. It's called farm income averaging. And the point here is not to make you an expert in farm income averaging. The point here is to expose you to this concept so that you can have a conversation with your accountant, or you can learn more about it if you want to. It looks really messy. It looks really complicated. There's a lot of moving pieces. It's really not that complicated. I'm convinced that anybody with given the right tax returns and a pencil and a calculator can figure it out. I'm just giving you that warning up front, because as I go through this, I don't want you to be like, you know, what in the world? The struggle with teaching this is that there's really not a good middle ground. You kind of have to see some and talk through it. At least that's my opinion. After you see this, you may start screaming at me in the chat, which I totally understand too. But what is farm income averaging? Farm income averaging is a tool that is only available to farmers, that it can be used to smooth tax liability over time. And so basically you can elect to spread your current farm income over the 3 previous tax, as long as you're doing it over the 3 previous tax years, assuming that you're doing it in equal proportion. So my quick example, don't worry that this is lagged a year, that the mechanics are the same, but assume that, you know, you've started out farming and you didn't make a whole lot of money for the first 3 years, and then, you know, in 2021 you did make a whole lot of money. You can see what your marginal rates would be there for those years: 10, 10, 12, and 22%. So income jumped up a lot in 2021. If we calculated the taxes on this, it would be a 13.91% effective rate. And if we thought about your 2021 taxable income situation as a cylinder, with the graduations being the different tax brackets, this is kind of what it would look like. If we did the same thing, the same exercise for the previous 3 years, you can see that those cylinders are not nearly as full as the one is for 2021. And so what this allows us to do is we can actually come back in here and tap into these unused tax brackets in the previous 3 years. So what we're going to do is we're going to take $105,000, that taxable income that we had in 2021, that farm income. We're going to divide it by 3, and then we're going to put $35,000 back in each of those 3 previous years. So I'm going to drop $35,000 back in my 2018, 2019, and 2020. And when we do that, then we get to calculate our taxes based on those lower rates, as opposed to the higher rates that we're facing in the year that our income jumped up. And in fact, we've lowered our effective tax rate from 13.91 to 11.46%. What is, well, the same disclaimer that I gave earlier about effective rates. We are only talking about the federal tax amount here. There really is no farm income averaging on the state side. It does nothing for your self-employment tax. You're still going to pay self-employment tax on the full taxable amount. Doesn't do anything for local taxes, but it is a way to potentially reduce the amount that you pay in federal income taxes. And you get to do that without amending those previous 3 years. It does nothing to change your adjusted gross income on the current tax return. It just changes the percentages that you use to calculate what that federal tax rate is. And so I encourage people to, if your income has jumped up, to consider using that and having a conversation with your accountant about it. A lot of accountants are not familiar with farm income averaging. And I tell people all the time, If your accountant doesn't know farm income averaging, it doesn't make them a bad accountant. They're capable of doing it, but it's used so little and only used by farmers. It's just not something they see every day. So have a conversation with them and they may be able to think through that with you. If you're trying to lower your taxes, one thing to consider too is Section 179 expensing. This is the contradiction on depreciation from earlier. You can write off up to $1 million of assets on the federal side that should be depreciated, and the limit for Kentucky is 100,000. 2022, we had 100% bonus depreciation, which essentially works the same way. There is no bonus depreciation for Kentucky. On the federal side, this is going to continue to decrease by 20%. So for 2023, it's 80%, and it's going to continue down until it goes to zero. Prepaying expenses is another way that you can lower taxes. So it's totally okay and legal if you want to buy some supplies for 2024 and 2023 to help offset your 2023 income taxes. In general, you're allowed to deduct up to 50% of the current year farm expenses in each category. So if you spent $5,000 in seed this year, you can spend $2,500 before December 31st, prepaying, your vegetable seed for 2024 and count it off on your 2023 taxes. You can actually exceed this 50% deduction if you refer to Internal Revenue Code subsection 464. If there's been a change in the business operation caused by unusual circumstances, or if you haven't exceeded that 50% in the previous 3 years, you can actually spend more than 50% on next year's supplies and count them off on this year. So I really tell people not to get too caught up on that 50% deduction limit, but understand that it exists. And the big point here is that it cannot exceed for more than 12 months into the future. So you can't get a benefit out of this for more than 12 months. I'm sorry, I'm looking at the time and there's a few things I really want to get through, and I talked too long before, so just bear with me here. There are rules for these prepays. You have to actually be buying something. You can't just be making a deposit. So it needs to be tied to a specific quantity at a fixed price. It has to be for a valid business purpose, like fixing price for supply. And the third one there is really interesting to me. There can be no material distortion of income. What that's really saying is that whenever you're doing this and you are reducing your income, you shouldn't have the thought that you're reducing your income, I guess, because prepaying stuff does materially distort your income, but that can't be the reason why you did it. You had to do it for reasons like making sure that you could get access to seed next year, or that there was a sale if I bought it now, as opposed to waiting till next year, and so on and so forth. You can never prepay interest. Interest is only deductible up until the 31st of the year, or up to the end of your accounting period. Sometimes people are interested in not paying self-employment taxes. There's two ways to do that: commodity wages and self-rentals. If you're interested in that, please reach out to me and I will give you some resources and then tell you to talk to your accountant. These are not super complex, but there are some things that you need to watch out for. If you're worried about your income being too low, some things that you can do is slow down depreciation expenses, and then consider depreciating other things. Tires have gotten really expensive, for example, and if you've got to put a set of tires on the tractor, you can easily spend a couple $1,000s. Instead of writing that all off in 1 year, you may consider depreciating that. All right, this is the last 3 slides here, I promise. Business losses versus hobby losses. So this is one of the areas that people get concerned about. And just to be clear what we're talking about here, Congress says that in order for you to deduct expenses in excess of income, you must be engaged in this activity for profit. And profit in this context refers to income being greater than expenses when you include depreciation. And we've already kind of talked about this. If you have a positive Schedule F any 3 out of 5 consecutive years, you don't have to worry about this. But if you don't have a positive Schedule F in any 3 out of 5 consecutive years, it doesn't automatically mean that the IRS sees your business as a hobby. but it does give the IRS justification to come digging into your operation and ask questions. So let's say that unfortunately, things outside of your control, you haven't shown a profit in the past 5 years. What can you do to help shore up your situation when the IRS, if they come knocking? One, so what I'm going to show you here are the 9 areas of consideration that the IRS looks at in making this determination. The first one is the activity carried out in a business-like manner. So this is things like having a separate bank account, having business cards. Really and truly, I'm not just trying to coerce you here. Having farm records is an indication that you're doing this in a business-like manner. The second area is consideration is the expertise of you and your advisors. So they will actually look and talk to you and interview you and figure out, do you know what you're doing? I don't know how they really determine that, but they'll also ask you, who are you talking to? Are you part of, any groups or continued education? So things like attending meetings like this and being able to refer back to that is important. They look at the quantity of time that's being invested in the activity by you. So if you're spending very little of your time, but showing a big loss every year, that could be a problem. I'm not telling you that you need to get a time clock and clock in and out, but you do need to be able to articulate to the IRS on average how long you're spending in the business on a weekly basis. Number 4 has always confused me. They do look to see if there's an expectation of asset appreciation. I'm not sure how you convince the IRS that you have that expectation. The 5th area of consideration is, have you ever done this before? And more specifically, what's your track record of doing it before? Do you have a tendency of starting farms and bankrupting them over and over again while making big losses to offset other income? Now, with that being said, good things happen, bad things happen to good people all the time. Do not be discouraged if you've had a situation that required a bankruptcy in the past, or if you haven't been successful in the past. The failure rate for small businesses is astronomical. And what they're really looking here for are people that are basically committing fraud. If you tried this before and it didn't work out, that's fine. You're trying it now, and hopefully it does work out. 6 is, what is the history? Can they look outside of that 5-year window and find a year that was positive? Area 7, can they go back to the beginning of time or the beginning of your business and find if you've ever made any money at all? Maybe it's just a down agricultural cycle or things outside of your control or weather related. Are you engaged in other income producing activities? This is a big problem if you have a really high off the farm income and you're losing a lot of money on the farm. That's going to get you in trouble, probably quicker than anything else. So think about that. If you're happening to lose a lot of money on the farm, but you make a lot of money off the farm, that could be a problem. And then last but not least, the last dig that I'll take at the IRS, are you having any fun? Because nothing upsets the IRS more than the thought of you recreating and having pleasure in life. What they're really looking at here is, are you taking extravagant trips and trying to write them off as business expenses? I apologize that the end of that I had to kind of condense. There is my contact information. I truly mean this. If you don't want to put something in the chat or, whatever, you're more than welcome to email me or call me anytime. And I am more than happy to talk through anything related to farm taxes or farm financial record keeping or financial statements or anything like that. Thank you very much for the invitation to be here. I've enjoyed myself this evening.
Thank you, sir, for coming and spending your time with us tonight. I do want to make a couple of comments. One is that the brown record books you were referring to are still available. Just swing by your local county extension office and they should have a copy. And if they don't, they can get a copy. Johnathan, what apps do you suggest for record keeping? You mentioned apps. Do you got any personal experience with that?
I don't. I've seen a lot. And I can't quote you any names off the top of my head, but if you just go to the Google Play Store, just do an internet search and just start playing around, typing in search terms, you will find things that pop up that, I mean, at face value, look kind of promising.
Sounds good. This is recorded and we will email out the link as soon as we get it posted to everybody that signed up on the email. I don't see any other questions in the chat, but I want to leave with the bad tip of the day, if you'll humor me, Jonathan.
Sure.
Why don't you want to buy anything with Velcro?
I don't know.
Because it's a total ripoff.
I love it. I love it. I will give you credit when I use it. I'll tell everybody that Philip told me that one.
That'll work. That'll work. Everybody have a good night. Stay safe through the storms and everything. We'll hope to see you here in a couple of weeks on April 6th, 6 o'clock. And we're going to be talking about what's bugging our garden. We'll hang on for a few minutes. If you have any questions you want to put in the chat, or if you want to talk to Jonathan, I'm going to stop the recording.